Assalamualaikum warahmatullahi wabarakatuh. Today, my groupmates and I will be presenting our solutions based on our discussion for this group project. There are 5 members in this group, namely NURNAYLI binti Muhammad SHOKRI, Hidayu binti BAHRU ANUAR, FARAH SYAHEERA binti HASSAN, SHARIFAH AMIRA binti ALWI, and last but not least, MARLYANA IZATIE binti Muhammad Adam.
Assalamualaikum, my name is FARAH SYAHEERA binti HASSAN. I'm from class AC220B3A. I will present about ITA or Pioneer Status, which is the best option. RSP Sdn Bhd is a capital incentive company that was awarded a contract to supply product X, a promoted product, to all the government's hospital in Malaysia. The incentive tax allowance is the most effective method for reducing its tax liability. The ITA incentive is preferable over the Pioneer Status incentive for projects which are capital incentive and which are not expected to generate large profit in a short time. Since RSP Sdn Bhd is a capital incentive company, so the company cannot utilize Pioneer Status. Capital allowance will be large, which will reduce the amount of income that is exempt from tax. At last, RSP Sdn Bhd should apply for ITA because Pioneer activity is a capital incentive and the minor losses in the first year of operation YA 2070 to YA 2020 can be carried forward until the exemption period until RSP become profitable in the 5th year YA 2021.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Hidayu binti Bahru Anwar. So today I will talk about commencement of business. Since RSP Sdn Bhd is a manufacturing company, the commencement date of business is when the company embarks on the production of manufactured goods. RSP Sdn Bhd will incur approximately Rm 40 million for the purchase of machinery and Rm 500,000 for staff remuneration prior to commencement of manufacturing process. It is not deductible because it is not incurred wholly and exclusively in the production of gross income. Both TSB Sdn Bhd and INARA Sdn Bhd have current year losses, so the business loss can be carried forward to the future years for the offset against all business income. Since TOP Sdn Bhd is a profitable company, the capital allowance of the company will be set off against the adjusted income of the business to arrive at statutory income.
In my opinion, I would say choosing the outright purchase of asset for asset not qualified under ITA is the greatest option because we can see here that it got more benefits from the other option, which is the company is able to claim capital allowance based on the full cost of eligible assets. Furthermore, for the first year, RSP Sdn Bhd is eligible to claim the initial allowance and annual allowance, and it does not stop there. RSP Sdn Bhd can also continue to claim yearly allowance in the following years. In conclusion, purchasing asset through leasing would mostly give you cons, such as the company will not be eligible to claim capital allowance on the leased asset due to the company not being the owner of the asset.
Assalamualaikum warahmatullahi wabarakatuh. My name is NURNAYLI and I will be explaining question D. For question D, I am required to advise RSP Sdn Bhd on the interest restriction for RSP, financial institution and TSV. Before answering, let me explain a few things first. According to Section 33, Subsection 2 of the Income Tax Act 1967, where a taxpayer has borrowed money for the purpose of producing business income and has also lent or invested money otherwise than for the purpose of producing business income, the deductibility of the interest paid on borrowed money would be restricted based on the formula, which is investment over borrowing times interest expense. The amount of interest restricted would be added back to arrive at business adjusted income and would be allocated to individual investment source. If the restricted interest cannot be offset against the related investment, the excess interest expense cannot be carried forward and it would be a permanent loss. Furthermore, if the investment is in the form of loan, then the investor company would charge the required amount of interest income to offset the interest expense suffered. This would ensure deductibility of interest expense. Now, back to our question. So, as for RSP Sdn Bhd, as stated in the question, the fund for the construction of the 5 blocks of apartment is internally generated. The company also lent the loan which is provided by the financial institution to its subsidiary, TSV Sdn Bhd. The amount of interest incurred is non-allowable expenses and hence is not allowed for full deduction. This is because the borrowed loan from the financial institution is used for non-business purposes. It is also clearly stated that RSP has to pay interest at market rate, which is much higher than the interest rate charged by RSP to TSV. So, to ensure full deductibility of interest expense, RSP should charge a higher amount of interest income from TSV in order to offset the interest expenses incurred. As for the financial institution, the solution that can be considered to overcome the interest restriction is RSP needs to review charges annually for cheaper financing to ensure interest expense charge on market price is lower. Next, RSP should make arrangements for TSV to obtain the loan directly from the financial institution. As a result, the company will overcome its interest restriction problem and reduce its tax payable. Other than that, according to subsection 33(2) of the ITA, if a person has borrowed money for the purposes of business as well as for non-business purposes, the interest charged to the profit and loss account may not be allowed a full deduction. For example, money used for non-business purposes are investment in landed properties, shares, securities and Islamic securities, placement in fixed deposits, and loan given to some other person. So now, as for TSV Sdn Bhd, the loan given to TSV that is borrowed from financial institution by RSP is for non-business purposes. So, TSV will not be eligible to claim full deduction on interest expense in arriving at adjusted income. However, the loan made to TSV had not been utilized directly or indirectly. Hence, it may be claimed that there is no investment and loan incurred. Therefore, there will be no restriction on the interest expense allowable to set off against adjusted income. When there is no interest restriction, the company can deduct more from its income and decrease its tax liability.
Hi, my name is MARLYANA binti Muhammad Adam. Today I'm going to explain about disposal of fixed asset. Here is the explanation to dispose the asset. If the sale proceed of a fixed asset exceed its residual expenditure, the excess is known as balancing charge. The amount will be added to the adjusted income to derive statutory income from business. However, if the sale proceed of a fixed asset is lesser than its residual expenditure, the difference will be treated as a balancing allowance. In this case, when RSP Sdn Bhd dispose of its machineries and they sell them at a very high resale value, which can benefit the company from the losses to offset the balancing charge. RSP Sdn Bhd has not yet to decide as to whether to dispose of this asset to its subsidiary INARA Sdn Bhd or to an unrelated company. If the company disposes the fixed asset to its subsidiary INARA Sdn Bhd, it is called a control transfer as is subject to the control provision of Income Tax Act 1967. When referring to the transfer control provision, the asset will be deemed to have been transferred at the tax written down values of the control's condition, and the asset will be deemed to have been transferred at the tax written down values of the transferor, and hence no balancing charge of balancing allowance will arise on the transferor. However, INARA Sdn Bhd is still entitled to claim an annual allowance based on the original acquisition cost of the asset. The control transfer will benefit the RSP Sdn Bhd since the INARA Sdn Bhd is forecasted to obtain a current year loss 800,000 ringgit annually. Although if RSP Sdn Bhd decide to dispose of the asset to an unrelated company, this will cause the statutory income from business to increase because the balancing charge is added to adjusted income of the business. As for the conclusion, to minimize the tax liabilities, the company should dispose of the fixed asset to its subsidiary, INARA Sdn Bhd. It is because there is no balancing charge or balancing allowance arise on the disposal.
Based on the RSP Sdn Bhd company, it is a resident company and has a paid-up capital amounted to 40 million. The company has forecasted minor losses in the first year of operation. To minimize the tax liability, RSP Sdn Bhd is eligible to surrender 70% of the loss to its related company within the group. For example, the loss can be transferred to the top Sdn Bhd to ease the tax burden.
Okay, next we will move to group relief for subsidiaries. For the TSV Sdn Bhd, it is a resident company and has paid up capital of only 60% of the company group. The company has a current year loss of Rm 300,000 annually. Therefore, TSV Sdn Bhd cannot surrender its forecasted current year loss of Rm 300,000 annually to RSP Sdn Bhd, or RSP cannot transfer its minor forecasted loss in the first 4 years of operation to TSV Sdn Bhd. To minimize the tax liabilities, TSV Sdn Bhd can deduct its current year loss of Rm 300,000 against its aggregate income from business income under Section 4A. As a result, the company can lower its chargeable income to reduce tax payable.
As we can see here, INARA Sdn Bhd is related to RSP Sdn Bhd and is a resident company in Malaysia. Annually, the company is expected to have a current year loss of Rm 800,000, and since RSP Sdn Bhd acquire 75% of share capital in INARA Sdn Bhd, RSP Sdn Bhd is able to transfer their business losses to INARA Sdn Bhd and vice versa. Unfortunately, INARA Sdn Bhd as a claimant does not meet one eligibility requirement, which is the claimant must have a defined aggregate income in that year assessment. Hence, only INARA Sdn Bhd can surrender its current year loss to RSP Sdn Bhd Rm 800,000 to minimize their tax payable.
Based on the top Sdn Bhd, the company is related to RSP Sdn Bhd and is a resident company in Malaysia. The company has aggregate income amounted to 1 million and no forecasted current year loss incurred. Since RSP Sdn Bhd holds 73% of paid share capital in top Sdn Bhd, RSP Sdn Bhd can surrender its accumulated unabsorbed business loss to the claimant, top Sdn Bhd, to reduce tax liabilities. However, in top Sdn Bhd perspective, the company can still minimize its tax burden, even earn profit if the business is said to be the same sources as the existing business. The profitability of the new business will be able to utilize the unabsorbed capital allowance of the existing business or unabsorbed business loss from any business. As a result, top Sdn Bhd provides management service and gain profit in year assessment. The company can absorb the RSP Sdn Bhd accumulated unabsorbed business loss in the first 4 years of production to lower its chargeable income and minimize its tax payable.